In this presentation, we will work a problem related to a tax anticipation note payable. The information is going to be on the left side. We're going to put that into the blue area on the right side. We will record journal entries into the general journal here, posting them to our trial balance worksheet in the middle column. The trial balance giving us an idea of the accounts involved and seeing these accounts in relation to each other and being able to work with something that is in balance, which really helps us to get an idea of these transactions and these accounts that we will be working with. We'll do the same transaction in the government-wide funds as well, this being on an accrual basis, the government-wide, as opposed to the modified accrual with the general fund, and we'll record this information in a similar fashion here, again having a beginning balance that not necessarily in practice would the beginning balance of course be the same as the general fund or so related to the general fund, or depending on what other types of funds are there, it could differ. However, we want to start off with something that has a beginning balance so that we could see something that is in balance and we could see these accounts related to each other as we post to the government-wide accounts as well. So our data is going to be on the left side. In essence, the scenario is going to be that we're going to have expenses that need to be paid for. We typically pay them with the tax revenue that we're going to be anticipating in the future. And therefore, we need to finance the current activities with some type of loan, which is going to be, we're going to call it tax anticipation note. And then we're going to receive the taxes in the future, at which point we can then pay off the note. So the information will be on the left side. We have the estimated tax anticipation. We have the financing needed. So we're going to need, we're estimating $2,300,000 in the financing. The estimated collection from revenues other than current property taxes and delinquent property taxes is going to be this $1,290,000. So we're going to do basically a calculation to get the anticipation note financing that we're going to need. So we're going to start off with this $2,300,000, and then we're going to take a look at our trial balance and see what kind of liabilities we have over here, which includes this payable of $860,000. So we're going to have to pay that off. That's going to be current. I'm going to say negative of this number. So we're going to add those up. So this is going to be summing these up. We're going to say equals the sum of these two items. And then we're going to say, well, what do we have right now? What's the current cash that we have on hand? We're going to take that from our beginning trial balance. We currently have the $800,000 at this point in time. And then we think we're going to be collecting this $1,290,000. So that's going to be the taxes that we have assessed that we expect to collect. If we sum that up, equals the sum of these two items, we get the $2,090,000. So, and these are going to be the current taxes we expect to collect. So the difference between these two is what we think we're going to need in terms of financing. So we're going to say this is this minus this. That's going to be the anticipation note that we're going to take out. So now we're going to basically do the same kind of thing we would think of with a note. What are going to be the terms of the financing of the note? We're going to say it's the number of months. We only need it for 6. The interest rate is 6%. Now remember, when we calculate the interest rate at 6% means 6% a year. So we're going to have to break that down to what would that mean for 6 months. So if we calculate the interest, I usually do it just kind of a long way here to make it so we could see each step. So we would say to calculate that times the interest rate, 6%. If we multiply that out times the 6%, and then that would be for a year. And then I would take that and divide it by the number of months, 12. Now note, this is half a year. You could divide it by 2, or you could obviously take the interest rate and divide it to a monthly or a 6-month interest rate if you want. But I think this is the way that works with just about any type of calculation. It's easier to see. So we're going to say this, the 64.2 divided by 12, that would be the amount per month. And then how many months do we have? We have 6 months. And so we're going to take this times the 6 months that we have. And that's going to be the $32,100 interest on the note. Okay, so then we're going to record this. We're going to record the note first off, and it's going to be in the general fund. And the note is going to be simply the same thing that we would expect it to be. Cash is going up. We're going to say we're going to get cash, and we're going to put the other side into a payable, a note payable. So it's going to be the tax anticipation note. It's for 6 months here. So it's going to be less than a year. So within modified accrual, we're going to keep it on the books. It's less than a year because it's going to be the short-term financing of what we need. So we're going to say this is going to be equal to then this amount that we calculated. That's what we think we're going to need. That's what we're taking the note out for. And then we would record that. We're going to post this out. Cash would go up, so we're going to post the cash. That's going to be in 03 equals, and we're going to point to that 1,070,000. And then the tax anticipation note is the credit. That's going to be in 010 equals the credit. Whoops, now that's not in 010. Let me delete that. It's in 011 equals the credit of 1,070,000. So there we have it. If we would do this on the government-wide, it's in essence the same thing. So this would be on the full accrual versus the modified accrual. There's no difference here in the modified and the accrual basis in essence. So we'll record the same thing for the government-wide. So I'll just say government, and then activity. And we're going to say that cash is going to go up. Cash is increasing. And once again, tax anticipation note is the other side. I'm gonna draw the number from the prior worksheet. So I'm going to draw it from here. Same amount. And we'll post it out in essence the same way. So cash is going to be up top. We're going to be in Y3 equals the cash 1,070,000. And then we're going to go to the tax anticipation note here. So we're going to be in Y11 equals, and we'll scroll up to that 1,070,000 as well, putting us back in balance. Now we're just going to record the payment of this item. And so we're going to say that we made the payment plus the interest. And that's just, and so at the 6 months later, we make the payment plus the interest. It would look just like we would expect it to look for the most part on an accrual basis. We've got the general fund. We're going to say that we're going to pay off the note. So we're going to take it. So we're going to be in I6, and the note's going to be off the books. So we're going to take off the note payable. It's going to be for the same amount. Then we're going to have to record the expenditure, which is interest. So the interest is going to go to an expenditure instead of an expense, because this is the modified accrual. And that's going to be equal to the interest that we calculated, 32.1. And then the credit is going to be the negative sum of these items. We'll add those up. That's how much cash, of course, we're going to pay. So that's going to be the cash. We're going to say this is equal to cash. And there we have it. So let's go ahead and post this out. So we got the tax anticipation note. It's going to go back down because we're paying it off 6 months later. Short-term note here. That's going to go back down to 0. And then we've got the expenditure. So we have the expenditure equal to the 32.1 and the cash going back down. So there we have that, and we'll do the same thing in essence for the government-wide, although we're going to call the expense account expenses now because we're on a full accrual basis rather than the modified accrual. So we're going to do the same type of transaction here. We're going to say that the tax anticipation note, and then we've got the expenses, which in essence is the interest now. It's just called something a little bit different because we're now on the full accrual basis. Cash is going down. Numbers will be the same. I'm going to pull this from the prior journal entry. Just going to pull that over. I'm going to copy it. I'm just holding Control-C, Control-V, Control-V. I'm just pasting the formula, and there's our transaction. And so then we're going to go and post this out. Here's the tax anticipation note. We're going to be in the tax anticipation note. Something's in it. Double click on it. Go to the end of it, plus, and pick up that amount. And then we're going to post the expense. That'll be down here. And the expenses in Y14 equals. And we'll pick up that 32.1. And then the cash, we'll pick up the cash amount in Y3. Double click on it. Go to the end and plus. And there's the cash being decreased. So again, short-term note. And therefore, under the modified accrual, we have it on the modified accrual here. And then we're going to record a similar transaction in the government-wide accounts as well. Similar transaction between the modified accrual and the full accrual of the general fund and the government-wide respectively.